You're making real money freelancing now, maybe $60,000, maybe $90,000, and someone in a Facebook group told you to form an LLC. So you're wondering, is it time? Will it save you on taxes? Here's the honest answer most people don't get. An LLC by itself saves you nothing on taxes, zero. According to the IRS, a single-member LLC is taxed as a sole proprietorship by default. Same tax treatment, different letterhead. The structure that actually cuts your bill is an S-corp election, and that only makes sense above a specific income threshold. By the end of this video, you'll know exactly what that threshold is, how to calculate it for your situation, and what the right move is for where you are right now. What an LLC actually does for your taxes. Let's kill the myth immediately. When most freelancers hear LLC, they picture tax savings. That's not what an LLC does. An LLC is a legal structure. It creates a liability shield between your personal assets and your business. If a client sues you, they're suing the LLC, not you personally. That matters. But it is a legal benefit, not a tax benefit. By default, the IRS treats a single-member LLC as a disregarded entity. Your business income flows straight onto Schedule C of your personal 1040. You pay self-employment tax on all of it. You pay income tax on all of it, exactly like a sole proprietor with no LLC at all. Now, an LLC can elect to be taxed as an S-corporation. That is where the tax strategy lives. But the LLC itself is just the legal wrapper. Don't confuse the container with the contents. My take is this: if liability protection matters to you, and for most client service freelancers it does, form the LLC for the legal protection alone. Just don't expect it to move your tax number until you make the right election. The self-employment tax problem. Here's the part that stings. As a freelancer, you pay self-employment tax on your net profit. For 2025, that rate is 15.3% on the first $176,100 of net self-employment income. That's the combined Social Security and Medicare rate. Above $176,100, the Social Security portion drops off, but you still owe 2.9% Medicare on everything above that. And if you earn over $200,000 as a single filer, the additional Medicare tax adds another 0.9% on top, according to IRS Publication 15. What makes this brutal is that you're paying both the employee side and the employer side. When you had a W-2 job, your employer covered half. Now you cover all of it. On $100,000 of net profit, that's roughly $14,130 in self-employment tax before you even touch income tax. You do get to deduct half of that SE tax as an adjustment to income, but you're still writing a large check. This is the core problem that the S-corp election is designed to solve, and understanding this problem is what makes the solution make sense. The S-corp election, where the savings live. When your LLC elects S-corp status, income stops flowing entirely through Schedule C. Instead, the S-corp pays you a W-2 salary, called a reasonable compensation, and any profit above that salary passes through to you as a distribution. Here's the key: W-2 wages are subject to payroll taxes. Distributions are not. So if your business earns $120,000 and you pay yourself a reasonable salary of $70,000, you owe payroll taxes only on the $70,000. The remaining $50,000 comes to you as a distribution. You saw no self-employment tax on that portion. At 15.3%, that's roughly $7,650 in savings on that $50,000 slice. The IRS is not naive about this. Reasonable compensation is a real requirement. The IRS actively scrutinizes S-corps that pay artificially low salaries to push income into distributions. According to IRS guidance and tax court precedent, your salary should reflect what you'd pay someone else to do your work. If you're a freelance developer billing $150 per hour, you can't pay yourself $25,000 a year and call it reasonable. The right salary varies by profession and market rate. Your situation will determine that number. The savings are also partially offset by the Section 10998A Qualified Business Income Deduction. Under Section 10998A, eligible self-employed individuals can deduct up to 20% of qualified business income. for 2025, that deduction begins to phase out for specified service trades at $197,300 for single filers and $394,600 for married filing jointly, according to IRS Revenue Procedure 2024-40. If you're below those thresholds and your profession qualifies, the QBI deduction already gives you meaningful tax relief, which actually changes the threshold calculation for whether an S-corp makes sense. We'll come back to that. The real income threshold, a worked example. Here's the number you came for. The general threshold where an S-corp election starts to make financial sense is around $80,000 to $100,000 in net self-employment profit. Here's exactly why. Running an S-corp is not free. You need to file a separate Form 1120-S every year. You need to run payroll for yourself. You'll likely pay for payroll software or a payroll service, and you'll probably want a CPA to keep you compliant. Realistically, those costs run $1,500 to $3,000 per year, depending on where you live and who you hire. Call it $2,000 as a working estimate. Let's walk through two scenarios side by side. Scenario 1. You earn $75,000 net profit as a sole proprietor. Your SE tax is roughly $10,597. You deduct half, which reduces your taxable income slightly. No S-corp. Now take the same $75,000 through an S-corp. You pay yourself a reasonable salary of $50,000. Payroll taxes on $50,000 run about $7,650, split between your W-2 withholding and the employer match the S-corp pays. The $25,000 distribution is SE tax-free, saving you roughly $3,825 on that slice. But subtract the $2,000 in S-corp administrative costs. Your net savings, roughly $1,825. That's real money, but it's not transformative, and it requires significantly more administrative complexity. Scenario 2, you earn $120,000 net profit. You pay yourself a reasonable salary of $75,000. Payroll taxes on $75,000 are about $11,475. The $45,000 distribution saves you roughly $6,885 in SE tax. Subtract the same $2,000 in admin costs. Net savings, approximately $4,885. Now it's worth the hassle. The math is clear. The right move is to wait until you're consistently clearing $80,000 to $100,000 in net profit before pursuing the S-corp election. Below that, the savings barely cover the cost and complexity. One more variable: if you're under the Section 190A phase-out threshold and your profession qualifies for the QBI deduction, you're already getting a 20% deduction on your qualified income. That reduces your effective income tax rate meaningfully, and it slightly raises the bar where an S-corp starts to win. Factor that in for your situation. The edge case that trips people up. Here's what most people get wrong when they finally hit the threshold and decide to move forward. They form the LLC and elect S-corp status, but they wait too long in the tax year to make the election, and they blow the deadline. To be taxed as an S-corp for the current tax year, you must file IRS Form 2553 no later than 2 months and 15 days after the beginning of your tax year. For a calendar year business, that deadline is March 15th. Miss it and your S-corp status doesn't take effect until the following January 1st. You just left a full year of potential savings on the table. There is a late election relief provision. Revenue Procedure 2013-30 allows you to request relief for a late Form 2553 filing, but it requires reasonable cause and comes with extra paperwork. Don't put yourself in that position. If you decide the S-corp election makes sense, file Form 2553 before March 15th of the year you want the election to apply. Put it on your calendar now. The second edge case: some states don't recognize S-corp status for state income tax purposes. California, for example, levies an additional 1.5% franchise tax on S-corp net income, with a minimum of $800 annually, regardless of profit. That state-level cost needs to factor into your break-even calculation. Your federal savings might be real, but your total picture includes your state. Run the numbers for your state specifically. I help freelancers figure out the money side of going solo. And the LLC question is the one I see mishandled most consistently. Form it when the income supports it. Elect S-corp status when the math wins, not before. Disclaimer. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. CTA. If this framework helped you, subscribe. We publish the financial playbook your employer would have given you, but for solo workers every other day. Next up, the IRS may owe gig workers up to $25,000 in tip income tax adjustments, and most people don't know how to claim it. That's coming next. Drop a comment with the freelance tax or money question you want me to dig into. I read everyone and build the upcoming videos around what you're actually wrestling with. This video may contain affiliate links. I only recommend tools I use personally.